Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is my good friend, Adrian Day. He is the founder of Adrian Day Asset Management. Welcome back, Adrian. It's always a pleasure having you.
Well, thank you for asking me, Ivan. Good to be
Yeah,
here.
yeah, it's always a huge pleasure having you on. Last time we spoke, you said the Fed has trapped themselves. It's a trap basically of their own making of the past 30 years since Greenspan bailed them out on long-term capital. How bad is their dilemma right now? How will it affect silver and gold?
Huge question. Yeah, I mean, they really are trapped because excuse me, although
That's
the
okay.
headline inflation numbers have been coming down in the last few months, both the consumer price index, which most people follow, and the core PCE, which the Fed seems to like. Well, they seem to like it when it's lower, but we'll see if they still like it when it's higher. But although those have been coming down in the last month, there are certainly indications, and I said this, I think, on the last time we talked, there are certainly indications that after another month or two, perhaps of lower inflation numbers,
Right.
we're going to start to see them move up again. And at the very minimum, inflation is going to be persistent, in my view. We're not going to get down to 2% or below 2%. But at the same time that that's happening, the economy is really beginning to show signs of slipping into a recession that are really difficult for anyone to ignore at this point. I mean, a few months ago, we had talk of no landing, then we had talk of the soft landing.
Right.
And then, of course, at the last meeting, Powell was asked, and he said, yes, there's still a path to a soft landing. We just have to find it, which I thought was an astonishing comment.
Uh,
We just have to, but I think, you know, the progression of the narrative, both from the Fed and frankly, market expectations are getting worse with each month that comes. And I think they're also lagging the reality. The reality in my mind is that we are setting ourselves up for what could be a very long-lasting and potentially serious recession or financial crisis. And I know I've been saying this for a while. The headlines, you know, you look at the unemployment rate, 40-year low. Good. Employment must be fine then. Consumer spending up last year, and the biggest driver of the GDP growth in the last quarter. Consumers, they must be okay then. But, you know, if you lift up the hood, we know that neither of those two things are true, neither the employment nor the consumer. And if we just look at the consumer for a second, you know, the consumer is continuing to spend, but the increase in consumer spending on a dollar basis is less than the rate of inflation, meaning already consumers are buying less in terms of volume or quality that they did before. But more importantly, we're seeing, as we know, the savings rate has absolutely collapsed. Now, savings were strong heading into this period because of the COVID lockdown.
right.
When a lot of people, I mean, a lot of people actually use those stimulus checks or whatever they were. I mean, I didn't get one, but the people who got them used them. Some people used them to cut down on credit card balances and to add to savings. Right. So we went into this period a year ago with pretty high savings in absolute levels. Those savings in absolute levels have begun to come off. And more importantly, the savings rate, new savings, has just collapsed. So that is an indication of trouble ahead. Credit card balances have risen to what, 20-year highs. That is a sign of trouble ahead. When people who used to pay off their balance aren't doing it anymore and are slowly building those balances. And with interest rates moving up, they're paying more on those balances. Meaning that the brick wall, they're going to hit the brick wall sooner. The other thing that's happening, of course, is that at a lot of banks, the credit card defaults have now started to increase. So, I mean, it's a natural progression. You start to spend a little less, then you use your savings, then you stop saving, then you use your savings, then you build up your credit card balances, and then, oops, you can't pay off the balance and it's a default.
Where do you see, Adrian, with all this chaos, where do you see silver and gold going? Like, do you have a gold price target by the end of 2023?
Well, I'm not a big fan of, as they say, if you're going to predict price or predict time, but don't predict both. So, I mean, I'm very, very bullish on the precious metals, both gold and silver, but frankly, particularly gold, which I think has a better risk reward than silver.
Right.
Although silver has the potential over the next 12 months to give us far greater returns, in my view, than gold. But on a, so different. So I like both, and I have both. In terms of a target, so much depends on what happens, what the Fed does, and what what happens in the economy.
Exactly.
I mean, I think we could easily end the year at 2,200 gold, and I know some people will say, "Well, boy, that's not very aggressive, Adrian." but we don't really. If gold goes to 2,200, let's say silver then goes to 30 to 35.
Yeah, that'd be huge.
That would be huge, and it'd be huge for the stocks. If gold goes to 2,200. The big cap stocks are going to go up 30 to 50% from here, or 20 to 30, let's say, and many of the smaller cap stocks will double and triple.
Right.
So those, although some people will say that's not very aggressive, I think for the stocks it would be a fabulous price, because the stocks haven't really moved. The stocks are still, when I say they haven't really moved, the seniors obviously moved this year. And nicely, but in terms of, but juniors haven't really moved. The vast majority haven't moved. And in terms of valuation, both the big cap and the small cap are still very, very undervalued. So you get gold firmly above 2,000 and new highs, and we're going to see very strong moves.
Well, with the way CPI is, the Fed actually can't pause at this point, right? Because it'll look like they've been giving up on the fight on inflation. But you look at the bond market, it's already broken. And what will break next, in your opinion? The real estate market? Will millions start losing their jobs?
Well, let me just comment on the first thing you said. Yes, I think we'll see one more hike next week, right?
Mm-hmm.
That's already sort of priced in. So the Fed has cover to give another hike. That will probably, I suspect, will be the last one, because as you say, they can say, well, look at course PCE, which is what we look at, and look at the month-to-month numbers. We're basically at our target on a month-to-month, not on a yearly basis, of course. So they will probably use that as an excuse to pause, and I think that will be a huge mistake. Because, as I said, I've said this before, so I'm not just saying it now. At the beginning of the year, I said I thought that the inflation numbers, what we call inflation, inflation is really credit creation, but what we call the inflation numbers, the CPI and the PCE, I said we should expect those numbers to come down for 3 or 4 or 5 months. So I'm looking at them bottoming out May or June. And a lot of reasons for that. We had the gasoline, and then we had the, let's not forget that in the consumer price index, but what's called the housing equivalent rents is the largest single component. And they do this in a very peculiar way, these owner equivalent rents. They don't really look at, what apartments are actually renting for. Like if I have an apartment and I renew my lease, that doesn't get included at all. And so it's only new leases. And we've seen those lag the market in the last few months. And in fact, in the last 3 months, but in the last 3 months, apartment rents have started to move up. But it's a lag before those higher prices come into the CPI because of the peculiarity of the CPI. You look at the oil price, bottomed in the 3rd week of March. Don't quote me. I don't have it in front of me, but something like that. Second or third week
Right.
of March, it bottomed. So the March CPI number already included, half of it was at the lower oil price anyway, and then the oil price doesn't immediately translate into higher gasoline and higher. It's pretty quick, but it doesn't immediately translate into higher transportation costs, right? But in April, we'll begin to see that if the price of oil stays where it is. So in April, we'll see higher costs because of the price of oil. In May and June, we're likely to see higher rental prices because of the rental prices already moving up. So I think we're going to see perhaps another month, maybe 2 months of lower CPI. And so the Fed, I suspect they'll pause, and they will pause at precisely the wrong time, just as the CPI hits that bottom before it starts to move up again.
Because that's the biggest danger, is the lag will catch them out. Inflation, oil prices will go back up again because of the lag. Then they have to raise rates again after their pause, is what you're
But I don't think they will.
Really?
Because if they pause now, they're not going to turn around. If they pause now, they'll need some pretty dramatic economic, positive, that is negative inflation, inflation negative reports to make them start again. I think they really want to. I mean, two things. Some members of the board of the Fed want to see the full impact of what they've already done. I mean, I'm not alone in saying that the economic impact of what they've already done has not yet been seen. And so there's some people on the Fed who are thinking, let's just pause and see what happens. Well, you don't pause for 1 month to see what happens. You have to, once you pause, you give it a few months. And I think they'll be frankly lulled by the lower PCE numbers into saying, okay, job done. But by the fall or autumn, I expect we'll start to see really clear evidence of a slowing economy, and also I think the possibility of a market decline by then, an earnings-driven market decline by then. Fed is less concerned about that, but we'll start to see a slowing economy, and we'll also run the risk that the higher rates that they've already implemented, if they keep on this higher for longer mantra, the effect of the higher rates we've already had will start to work through. And there may be more banks. Admittedly, the ones that went bankrupt were outliers, but they're certainly not the only ones that during that long period of low interest rates had to stretch for yield. They're not the only ones that have mismatch between deposits and liabilities.
Right.
They're not the only ones that use leverage. So there are other institutions, well, First Republic is an obvious one, but there are other institutions that are close to the brink. And other financial institutions, such as particularly banks and pension funds and insurance companies, which had the same problem, only magnified. The bank did. They have to earn a certain amount of money in order to meet their obligations. If you're a pension fund for a local government, right, where it's defined benefit, and you have an 8% target that you have to achieve every single year in order to pay your obligations, you cannot meet 8% just by investing in long-term treasuries, which is what they used to do. You have to either use leverage, or you have to go down the credit scale a little bit. Either way, you're taking risk, which is inappropriate for a pension fund. So the problems we saw in England in September, which surfaced very, very rapidly because of the drop in bonds um, uh, um, after the Liz Truss Kazwagi budget,
Yes.
which didn't go through. But those problems weren't caused by that budget proposal. That's just what brought them to the surface. And so when you've got to imagine that there are pension funds and insurance companies in the US in a similar situation, and a real collapse again in bonds could see those problems come to the surface.
Do you think it's a very high possibility we'll see that next year as this recession starts picking up, as the Fed can't even pause and they have to keep raising rates? Do you think we'll start seeing pension funds in the US start blowing up?
Yeah, I suspect within the next 12 months, and it will be less the economy for the pension funds, but what happens to bond prices.
Right.
Yeah.
Well, that's a scary outlook. That's a very scary outlook, Adrian. For
I don't mean to be scary.
No, not that. But it's good that that you come in and inform us here on Wall Street Silver. My last question for you before you go is, with all the craziness in the world, where are you finding safety for your money? I know you're bullish on precious metals. Is it gold, silver? Where are you putting your money right now?
Well, you did say safety. You didn't say for best returns. Yeah, certainly
Yeah,
gold
safety.
and silver would be number one without a shadow of doubt. And for safety, more gold and silver.
Right.
Gold and silver stocks, number two. And we are buying some high yielding business development companies, which sounds like an odd thing to be buying when you think the economy is going into recession. But if you look at the best of these, like Ares Capital, which is the largest and arguably the most conservative, or Gladstone Capital and Gladstone Investment, which are smaller but very conservative, you've got a good diversity. Their liabilities are fixed rate, and they have a diversity of lenders or capital sources. And on the lending side, they have fixed rate lending. And both of the companies I mentioned, and there are others, have very good workout groups, so that if the portfolio companies they lend money to get into trouble, they have workout groups that can go in, both financially help, but also help with expertise in trying to keep those companies afloat and turn them around. And both of those companies have extremely good long-term track records at companies that have gone on non-accrual, been unable to continue to pay their debt.
Right.
A very good record at turning those companies around and bringing them back on accrual. And the yields are very high. Ares is about 10.5 right now. Gladstone Investment is a little lower. It's about 8%, but they also pay quarterly extra bonus dividends based on capital gains. So last year it was over 10% as well. So that's, to me, a good place for people who want income. And then we're being very, very selective in global markets. Very, very selective and cautious, frankly.
Right. Well, it's a huge pleasure you sharing that with us. And thank you so much, Adrian, for coming down to Wall Street Silver. It's always a huge pleasure having you down. And hopefully we can have you on soon as the market develops.
Yeah, no, I'd love to. And thank you very much.
Yeah, huge pleasure. Talk to you soon, Adrian.
Okay.